Hello and welcome back to the ROI channel. This is for the ROI Club members, and we have our ROI monthly in-depth overview of a very interesting company. And today we're going to be talking about Viper Energy, ticker VNOM. Firstly, coming at you from Boca del Toro in the Caribbean Sea. So if there's any issues with the audio, it's because I'm just using my laptop. And also I've been a little bit sick with the flu. So I do apologize for that. Today, I will try and keep things as precise as possible. If you feel that I've missed anything or that you have any questions, absolutely either drop me an email or even better, put them in the comments section so that everyone can contribute and have access to the response. So that being said, housekeeping, guys, obviously I'm not a financial advisor. None of this is advice. It's just my opinion, my outlook, my take. Could be right, could be wrong, could be right for me and still wrong for you. So lots of factors to consider. Please take that disclaimer seriously. And with that out of the way, here's what we're going to talk about. So inflation, my big take is that people are severely underestimating inflation, in my opinion. And I think that we're going to see it come and go in waves, and we're going to see a weaker than expected CPI print at times, and people are going to get all happy thinking that the Fed are going to relax some of their policies. And in the short term, that may well be the case. But we need to remember that the Fed is continuing a tightening policy, even though the rates of change may be different. So what's the playbook? When I look out over the next 10 years, I do expect an inflationary decade, even a stagflationary decade, and it's more or less purely given the demographics, the geopolitics, and in particular, the debt levels of Western nations. So the disconnect between the revenue and the cost of goods sold in an inflationary environment, I want access to a business, a company, whatever, that can increase what it sells, the price, and increase the volume, and yet not have an equal and commensurate increase in the cost of said goods. In other words, I want at least margin maintenance and margin expansion. And I've spoken about this before in various places. We want to inflate the top line, so it is sensitive to inflation without that increase in the expense column. And I think that's going to be quite tricky. I don't think it's going to be as easy as most people think. So today we're going to look at potentially, in inverted commas, a safer way to play the commodity theme. And if you saw my interview from a couple of days ago with Shubham Garg, that's available for free on YouTube. I highly encourage you to watch it. We covered this exact topic in general, and he gives some really great answers. One of the ways to do this with the royalty or streaming type model, and that's the company that we're looking at today, Viper, we are essentially hedging. So I'm looking at, for this particular play, understanding there will be a capped upside if we do get that right tail risk as an oil speculator, and oil shoots up to a super high price. This royalty streaming plays will do well, but they won't do as well as those riskier, heavily leveraged names to the oil price. But in the meantime, when we're chopping and changing through different CPI prints and different WTI particularly, or crude prices, these companies will do well. They already have their hedges in place, essentially, from the way their business model works, and they will be able to have a steady stream of income, whether the price goes up, down, or stays in that kind of choppy sideways range. There's a good chart I've got for you that will showcase exactly what I'm talking about. So again, a refresher on the way I look at this thing. So I'm looking for asset light inflationary beneficiaries. So something with access to tangible assets, but their expense column is light. They don't have a heavy staff load, and they don't have a heavy maintenance CapEx requirement. Okay, for the most part, there are a few on the speculative side of things, but generally speaking, the royalty and streaming, anything with a clip the ticket type business model is what I'm looking for. One of those would be royalties, obviously exchanges or brokers. The issue is there, you generally have to pay up quite a lot for those particular businesses. Investment management, funds management businesses are excellent in general as an asset class. The problem is you really have to have the ability to trust the management, and you're really relying on the management to allocate capital well, raise funds, and charge the fees, as well as get investment returns. Toll or pipeline, so midstreamers, any pipeline type industry that's already spent the capex for the infrastructure is good. again, you just rarely find them cheap enough to make the valuation work. Some software businesses are excellent. Spoken a little bit about Dropbox and why I like that. Again, you just have to get the valuation, and it's going to take a lot of patience, and the opportunity may not come because everyone knows this, right? And so people are usually willing to pay up. So let's take a look. This is a chart I was referring to. Here you can look at a royalty streaming company and the broad index for producers and explorers, so XOP, a little bit more on the exploration side of things. VNOM here over the last, this is a 10-year chart, I believe. So we've had a lot of volatility in oil prices. You can see how it holds up. Generally speaking, the last 10 years for oil has been bearish, for me anyway. And the way I look at this is that you have much less of the downside. You do have much less to the upside. So VNOM has preserved your capital better. For argument's sake, should you have invested equally weighted amounts in the index for exploration and production versus the royalty company being VNOM. So I think that gives a good visual as to the rationale for this type of play. Here's a one-pager on the company itself. So revenue expected to come in 834 mil for 2023. That's the analyst's estimate. And they're giving a 5% CAGR. I think it's very, very low. I think they have better deals in place. They have quite a good amount of acreage, albeit in the Permian, which it does look like it's starting to roll over in terms of production. So I don't think there's going to be a lot of growth of production. But given oil prices and what I believe oil prices are going to do, already I think the company is very profitable at $75 WTI. So EBITDA expected to come in 753, and this is the difference. So they are looking to analysts are expecting them to grow their margins over the next 5 to 10 years. We've got a 10% estimated CAGR versus 5% on the top line. That's the disconnect that I am looking for. Growth in the top line, sure. Even more growth in the in what you take home. Okay, and the only way you can do that is by not having expenses grow at the same rate. Pretty straightforward. Free cash, good margins. And so here, as of today, enterprise value 4.4 billion, looking at a current free cash flow yield of 15%. That's pretty close to the historic mean. You have done better than that in the past, but I would say in terms of an EV to free cash flow yield, this company is currently fairly priced, okay, if you only look at that. The historic yield, if we come into an environment where people are looking to be able to deploy capital to escape inflation without the risks associated with going further out into the exploration and production curve, I think the royalties are where a lot of people are going to land, royalties and pipelines. So if you got bid up to a 12% yield, you'd have a 22% upside on that reversion alone, as of today, without taking into account future growth. Current net debt divided by its EBITDA minus CapEx, 1.5, so quite comfortable. 74 million shares on issue. Only should the company continue to buy that back, that would be a really good outcome. I think most people would be very happy with that. Price as of this morning, $29.50, and its return on equity has been 31% over the last 12 months. So yeah, steady Eddie, quite good. One page look at the balance sheet in graphic form. Market cap, shares outstanding have been coming down since 2018. This is good. Okay, that's what I want to see. Net debt slightly up for acquiring more streaming and more acreage. Price to tangible book is much higher than what a lot of the explorers are going at because there is a lot more in that book. So makes sense. Free cash flow, yeah. So if you're looking at the quarter, I think that they can do even better than that. Could they get to 180, 190, 200 per quarter? That would be amazing. 300 million plus in the half year would be really, really nice. I guess we'll see what happens, and comparing that to the current market cap, I think is pretty reasonable. EV to EBITDA, in the sort of the mid-range there. I don't think it's particularly cheap if you look at it that with that measure. I don't think it's particularly expensive given the current environment. Last 12 months' free cash flow was 308 million. Could they do that in a half year now and get that up to maybe 600 million? Everything's pointing in that direction, which would obviously bode well for the valuation. This is another thing I wanted to point out. So here we're looking at the free cash from 2014 coming down into where we had the really bleak days for the oil market. And if we look at 2020 and 2021, we had bleak oil market. We had obviously negative during a brief negative futures contract during COVID. The company was able to continue their free cash flows because they weren't exposed. They were hedged into top line revenue from their producers, and then they chose to spend more of that free cash in the next year to increase their future production, or their future revenues, I suppose, to secure them. And that's why you have this dip in 2021. And it's heading in the right direction. And I think that if they can keep that well above the $500 million a year mark, it bodes very well for the company. Okay, so if we look at everything kind of put into one page, taking into account earnings, because a lot of people use that. I don't love it for this type of play, but people do use that. So I have included it in the valuation, the EBITDA and the free cash flow. Here we've got all of those rolled into one. The discount rates I'm using are going up, guys. Why? Because we have risk-free rate going up. We have equity premiums should be going up. For the broad market, I can't understand people using the S&P with a 5.5%, 5.8% equity risk premium. I think it should be more than that. So anyway, that's what people are doing. Discount rate is the working average, weighted average cost of capital. And here are my assumptions for the growth rate in EBITDA. They are almost the same for free cash, which is extremely conservative given this company has a disconnect between those two items on the balance sheet. So at the end of the day, here we can see an average of the three gives an intrinsic value of around about $70 per share if things come to pass the way that I have modeled here. And if we're looking at a 2/3 margin of safety, $46 would be a suggested entry price to get that kind of return. Now, obviously, if you want a higher return, you can either tweak the discount rate, or you can look at it on an IRR basis. So here are the models that I have used. EV to EBITDA, I've used a 6 multiple. That's fairly conservative, I believe, for this type of company. And so I've also given them no credit for buying back shares. Okay, so I've said what if, using their EBIT and projections, using their average D&A and CapEx, okay, and changes in net working capital. Obviously, that's subject to change, but being extremely conservative, I think that it's fairly reasonable to value the terminal value of these cash flows. And that is very consistent with the previous valuation methodology. So here we can see an intrinsic value of 73.54, okay, discounted back, which would give us a target price upside of 149%, almost 150. And on an IRR basis, a raw IRR of 41%, okay, which is obviously quite handy, especially going into an elevated inflationary environment. If I break that down on a per share basis for you guys here, what I'm saying is if we look at the cost of buying the business today on a per share basis, $29.50, and on a per share basis, this is my base case for the free cash flow moving out over the next decade, discounted back at the cost of capital today, okay? Reinvesting at essentially the Fed funds rate, okay, or the 10-year. So I've said, can they do a little bit better at 5%? You can obviously use your own assumptions. So if we take into account that reinvestment, that MIRR, 28.61%, very, very good. For a business that has much less exposure to the downside of the commodity price, which you just saw using that price. So there we have it, guys. Any questions do feel free to leave them in the comments section. If you're not already following me on Twitter, by all means, do so, hit me up. And if you're interested in copying the portfolio or adding the public portfolio to your watch list, just download the eToro app totally for free. And then you can just add to a watch list if you want to follow along, or you can use it as a way to copy monthly, which is what I do personally with my own funds. I copy the master fund, and that's a good way for me, I believe, to hit my long-term investment objectives. Thanks for watching, guys, and I look forward to catching up with you in another episode. Until then, stay safe.